Time for some more Fed Frenzy. Joining us for that is Juli Niemann, Executive Vice President of Smith Moore. Good to see you. Juli, after 4 years of fighting inflation by raising rates, the Fed is finally ready to cut rates as inflation cools. Where does the economy stand right now with inflation, and what would a quarter point cut by the Fed tell us?
Well, basically, the Fed has really gone to almost extremes for them to leak this into the market very gently. Are you going to do a quarter? Are you going to do a half? They've been desensitizing the market to both directions. Bottom line is it doesn't make a heck of a big difference. It's all in the message that they're communicating. If you do a quarter, you're basically saying, oh, we still have a really big problem with inflation. And I know the big problem with inflation was what happened earlier, and that was in the services end of it. The service inflation is still really high. On the other side, though, gasoline's coming down, commodities are coming down, and even grocery prices are beginning to edge their way down. This has been a big sticking factor and a huge problem for the average American, groceries and food costs.
What if the Fed cuts rates by a half point?
That's what's baked into the market. Mortgage rates have not even moved on that anticipation of a half point, simply because we still have a real problem here with availability. There's a huge housing shortage across the United States, affordable housing. You can have any McMansion you want out there if you've got the money, but affordable housing is a huge problem. So it's not even a question of interest rates, because so you get a low interest rate, now you have to pay a preposterous price on it. We're looking at a problem that's not going away until we see more construction going on, and construction of developments. You can only rehab so much in the city, rehab here and there. We need bigger plans for housing here. And that's going to take a while to reconcile itself. It's been 15 years in the making, and it's going to take a while to work. So it really doesn't make, for the short run, any difference.
What are some of your suggestions for investors as rates will be coming down?
When short-term interest rates start coming down, the short-term interest rates were where you really were cleaning up. You had money markets yielding 5.5%. All kinds of good CDs out there. That's where the biggest impact is going to be. So now you're going to be paid to start lengthening your maturities, picking up the yield that way. That's a more normalized yield curve here. So take a look at the bond portfolio. And by the way, you should still be in bonds. It's just lengthening the maturities to nail down some of those better yields. I still like high quality bonds, because when you come into a recessionary environment, there will be credit failures. So be very careful when you start looking at high yield. There's a difference between junk bonds and trash. And there's a lot of trash out there right now.
That is a great warning for bond investors. Thank you, Juli.
Thank you.
Go to businessfirstam.com for where to see our show on TV.